Ladies and gentlemen, welcome back to another video. I'm very excited for this video. As you can tell by the title, we can finally start talking about some of my recommended stock choices and investments. I wanted to hold off on this up until now because I believe before you start investing, it's very important that you get yourself and your finances in check. You've heard me say multiple times before, you shouldn't be investing if you are in debt or you are uncomfortable with your financial situation. If that's the point where you believe you're at right now, go check out my other videos. We talk about how to make a budget, attacking your debt with the debt snowball, as well as other important things like saving for your children's college and setting up your retirement account. If you are comfortable with your financial standing and are ready to put money in the market so you can make more money, then I'll be sharing one of the stocks that I'm very bullish on and believe has a high level of success in the future.
Skies are clearing up.
Today I will be talking about Stored Capital, which is a real estate investment trust. Before I explain to you why I believe this stock has high upward potential in the future, I want to talk about what exactly a real estate investment trust is and also the benefits that they can bring. A real estate investment trust, commonly referred to as a REIT, is a company that owns, operates, or finances income-producing properties. These companies may not offer as much growth potential as, say, a startup in the tech sector, but they do offer a nice income stream through dividend payments, which will drastically help you grow your position over time. Something else to be noted about REITs is that they are traded the same way stocks are. You buy into the company and become a shareholder the same way you would do with Amazon or Apple. The only difference here is that instead of these trusts creating products to distribute, they own real estate portfolios and manage said properties, which allow them pretty consistent income from rent payments. Now that you know what a REIT is and how they function, let's talk about the benefits alongside them. They are a good investment if you'd like to start getting into that real estate market because they offer greater liquidity. Instead of buying a house and having your money tied up in that transaction maybe for a couple of years, you were instead able to purchase shares of the real estate investment trust in which you have the ability to cash out at any time. Additionally, these are advantageous investments because they offer diversification to your portfolio. Not only do they manage a multitude of different properties, but they also have a low correlation with traditional stocks. The next benefit I highlighted in orange because in my opinion it's one of the greatest benefits that real estate investment trusts offer. They are required to pay out as distributions 90% of their taxable income annually. This is one of the reasons that I like to hold REITs in my portfolio because of that high dividend yield. A company like Johnson & Johnson, who has a yield below 4%, will have trouble keeping up with the higher dividend payments of a REIT, who were required by law to pass off a majority of their earnings as distributions. The last benefit we'll be talking about is more of just a statistic which you should know. Public real estate investment trusts have outperformed the return of the S&P 500 for the past 40 years. This fact doesn't necessarily mean you should only hold REITs in your portfolio, but it does offer some insight on why they are beneficial to have alongside your more traditional stocks and bonds. So here is the one-year chart for Stored Capital. One of the reasons I'm so bullish on it currently is because it's trading on sale. You can see it's currently down 28% on the year, trading at $27.72. As I continue to explain why I believe you should purchase this REIT, it will become more clear that it's not necessarily trading at a lower price because of bad financials or poor performance in the past. Rather, it took a hit during the huge coronavirus crash and is now slowly creeping back up to its yearly high of $40.96. The next few pictures I'm going to throw up on the screen are from Stored Capital's most recent investor presentation. All this is public information and can be found on their website, but I took screenshots of the most important aspects so we can discuss them today. I first want to look at some of their portfolio statistics. You can see from 2018 to 2020 that they've added around 500 new property locations, as well as about 90 new customers. They are also continuing to diversify their industry holdings and have broken into 8 new industries over the past 2 years, putting them at 113. Another big reason I'm so bullish on this REIT is because Their occupancy is above 99%, and they currently have some of the longest lease contracts at around 14 years. This is really important to me when I look at these statistics because if you're buying into a company that has a bunch of properties to lease out, but no tenants to collect rent from, then they're going to struggle paying you high distributions. I believe that also speaks to the proper management of store capital, as they are able to retain their customers for a long period of time, upwards of 10 years. We talked about earlier how real estate investment trusts offer good diversification to your portfolio. Now I want to talk about how store capital is properly diversified in order to protect their personal real estate portfolio and keep that money pumping in. Of store capital's 2,500 properties, they're diversified across 49 different states. It looks like they're in every state except Hawaii, and this is very advantageous because, say there's a natural disaster in one state, if all their properties were there, that could be catastrophic to their business. But because these locations are spread out all across the country, it offers them some protection in that sense. The other way we want to judge a real estate investment trust's diversification is by sector. Currently, store capital is in 113 different industries between the service, retail, and manufacturing sectors. Roughly 65% of the customers fall into the service sector, with some of the largest industries being restaurants. This is why I believe the stock price is on sale. As the economy shut down, some of the investors didn't feel comfortable keeping their money here, but I urge you not to worry about this. As explained earlier, the average lease term is about 14 years. Because they have leasing agreements of around 14 years, store capital is still in a very good place to continue collecting rent payments for years to come, despite what the future holds. Additionally, around 18% of their portfolio lies in the retail sector, with 62 of these properties currently being leased to furniture stores. The retail customers that store capital chooses to lease to is that they generally target markets which cannot easily switch to or grow their online sales. For example, with furniture stores, people generally like to go see how it feels to sit on, the size of the furniture in person. Sometimes it's even difficult to tell what color the furniture is and if it will match the general ambiance of the room or not. They also have 60 retail properties which sell cars. This is another market which would be incredibly difficult to transfer mostly to online sales, as people need to test drive the car before they buy it. The last sector which store capital is diversified into and accounts for roughly 17% of their portfolio is manufacturing. I believe this is important because it hedges some of that risk involved with the current economic climate of the country. Although we're currently still experiencing coronavirus shutdowns, most, if not all, of these manufacturing customers are deemed essential business, so they have the ability to stay open and produce income over time. The next thing I want to talk about is some great points raised from Jesse Escalo. I believe that's how you pronounce it. Forgive me if that's incorrect. In his article on seekingalpha.com, 2 investments to load up before the recovery. I tend not to lean too far into what analysts are saying about particular stocks, as I believe it much more important to do the research yourself and come up with your own opinions based on the data you find. But I do like to use this website as a way of gathering information and getting a general feel about future investments. I urge you to go check out the article yourself, but here are 5 key points which I would like to discuss today. Compared to its peers, store capital has some of the longest leases, as previously discussed, around 14 years. This offers them a unique ability to retain customers for long periods of time and still succeed despite the market conditions. Additionally, during the regular economic times, store capital has a rent coverage ratio of about 2.5, and it's also important to note that store capital expects and will collect on missed or late rent payments in the future. Their leases do not allow for rent abatements, and this will be incredibly advantageous after the coronavirus crisis is over, as they will be in the position to collect those late or missing payments from the customers which are holding leases for upwards of 10 years. The last 2 points, growth advantage and superior management, kind of go hand in hand. Because of that strong management team, they are able to grow at a pace much quicker than their peers. The next picture I will show will display this. Here is a picture from the first quarter of 2015 to the end of 2019, which shows the dividend growth rate of Store Capital. Their dividend yield is currently 5.15%, but is growing at a rate 33 times higher than their nearest peer. I generally like to invest in companies with a dividend greater than 4% in order to beat out that average inflation rate, sometimes placing more importance on the dividend growth rate, as this can be more advantageous for a long-term investment in regard to them increasing that dividend yield over the years to come. I hope you guys enjoyed the video today, and I urge you to go look further into Store Capital and do your own due diligence before deciding whether you should purchase it or not. I believe the factors and statistics that I laid out offer clear insight as to why they are a strong investment over time and are a good buy despite trading at that sale price of minus 28%. Because of their diversification in different sectors, as well as that average lease term of around 14 years, I believe they shouldn't have any issue reaching that value of $40.96, as well as maybe even growing past this as their dividend yield increases and they begin to obtain a higher number of customers and properties as they've been doing over the past 2 years. As always, I'm Patrick Zimmerman. Thank you for your time and enjoy the rest of your day.